Hello everyone, welcome to the 156th episode of me learning how to trade in Forex. So in the last episode we went through understanding leverage. Basically leverage is a powerful trading tool which allows you to put a small deposit and gives you exposure to a much greater area of the market. So what did I write on there's a really good phrase that Dave used. So how some traders increase their exposure to the markets without increasing their initial investment. There we go. That's a better way to put it in. We've got the diagram that explains it here. Very nice diagram by IG, of course. So yeah, examples of leverage products. You can take a leverage position using a variety of derivative products, from simple spot trades all the way to complex options. And then when using leverage works for you, so if your trade does go well and the market goes in your favor, then using leverage is really good because it boosts your profit. But if the market goes against you and you lose a trade, well then leverage also amplifies that loss as well. So you just got to be careful when using leverage. And then the worst case scenario when using leverage is when your loss is more than the initial investment that you put in. So that's very dangerous, that is. And yes, the cost of leverage trading. So you essentially borrow money from your broker to open your leverage trade. As in all financial situations, borrowing money carries a cost. So some products will charge you to hold your position open after market hours. So in this event, your provider will make an interest adjustment to your account reflecting the cost of funding your positions overnight. So that's why leverage products like CFDs and spread bets can be better suited to short-term trades. So holding them for prolonged periods of time could end up costing a fair bit of money, which reduces your potential profits. Okay, and then you don't need leverage to be a successful trader. So without leverage, traders can buy the underlying asset without any loan component. Yes, this may reduce your profits, but it also reduces the risk, so including losing more money than you put up to open the trades. So if you're a beginner trader, avoiding leverage altogether might be a good idea. So there'll be enough for you to learn and manage without the added risks, and always practice using a demo account to get a feel of what trading in the market is like before you jump into the real one. And yeah, so when you do decide to use leverage, consider how much you're taking on board. So a margin requirement of only 10% sounds great if you're in a winning trade, but you could quickly wipe out your account balance if the market moves against you. And then we went through the lesson summary for leverage. So now we're on to the complexities of trading. The complexities of trading. 04/06 2024. So another aspect to think about when choosing the right product is how complex it is. In other words, do you understand exactly how it works? If not, you might need to learn the ins and outs of the product before adding it to your strategy. So learn how the product works before adding it to your strategy. Think about buying shares in a listed company. It's often regarded as a market participation in its simplest form. There are several aspects that might influence which shares you purchase, including price charts and movements, historical and current financial data, relevant macroeconomic events, and any first-hand experience of the company's product. Add currency conversion and the impact of interest rates to the list of considerations, and suddenly a basic investment can start to look complex. As soon as you step into the realm of speculative trading, the level of intricacy goes up a notch. By studying the drivers in any product or asset, you can better comprehend it. Right, okay, so buying shares in a listed company can be market participation in its simplest form. However, there are several factors to consider when which might influence which shares you purchase, such as price charts, such as price charts and patterns, historical current financial data, historical and current financial data, relevant macroeconomic events, relevant macroeconomic events, any first-hand experience of the company's products, any first-hand experience of the company's product, and then currency conversion rates, and the impact of interest rates to the list of considerations. So currency conversion, interest rates, and suddenly a basic investment can start to look complex. This can make a simple action quite complex. As soon as you step into the realm of speculative trading, the level of intricacy goes up a notch. By studying the drivers in any product asset, you can better comprehend it. So by studying the drivers in any product or asset, you can better comprehend it. Some assets like cryptos are appealing precisely because they seem simple. However, the extreme volatility in this market adds complexity to these assets, not to mention the growing number of altcoins and their different use cases. Commodities can also appear to be valued according to supply and demand. However, neither of these are constant. Production can occur at different price points, constantly changing the equation. Let's look at what contributes to a product's complexity and how it impacts the way you trade. Price. Historical and live charts like these track price movements. Price is usually the first thing that comes to mind when you choose a product. Factors which contribute to a product complexity, trading complexity. Price. Price is usually the first thing that comes to mind when you choose a product. You can usually find a trade's pricing and cost information on your deal ticket before you take a position. So can usually find a trade's pricing and cost information on your deal ticket before you take a position. Assets like shares are listed on exchange, so you can look up their prices and get historic charts. However, pricing isn't always straightforward. Some prices aren't easy to get a handle on. Rhodium is a small part of the platinum group metals, along with its better known counterparts platinum and palladium. Trading rhodium may be more difficult than other commodities because you might battle to get a live price for it. However, pricing isn't always straightforward. Some prices aren't easy to get. Rhodium is a small part of platinum group metals, PGMs along with better known counterparts, platinum and palladium. Trading rhodium may be more difficult than other commodities because you might battle to get a live price for it. Occasionally there's more than one source for the price of an asset. Also, there might be more than one source for the price of an asset. West Texas Intermediates, WTI and Brent, are different types of crude oil and therefore trade at different prices. If you plan to trade on this market, you need to make sure you know which price to reference. Other markets with complex pricing include bulk commodities and cryptocurrencies. If you choose to trade an asset that falls into either of these categories, it may be worth your while to look into how its price is sourced and structured by your provider. Other markets with complex pricing includes bulk commodities and cryptocurrencies. So i.e. West Texas Intermediate crude oil and Brent crude oil. Rhodium. Rhodium. Why is that? Okay, i.e. rhodium. Other markets complex pricing includes bulk commodities and crypto. If you choose to trade an asset that falls into either of these categories, it may be worth your while to look into how its price is sourced and structured by your provider. If you are trading either of these, look into how its price is sourced and structured by your provider. News and events. Another element that may contribute to the complexity of your trading and investing is the news. Economic data releases and breaking headlines often contribute to volatility in specific markets affected by the event. Economic data releases and breaking headlines often contribute to volatility in specific markets affected by the event. The impact of a news release. UK CPI data released, boom, massive up. This can add complexity to your trade as you need to monitor not only the relevant price chart, but also any economic events that might cause the price to fluctuate. So you'll need to monitor any economic events that might cause the price to fluctuate. In some cases, a release about one market can affect another. One release of news for one market might affect another. For example, a US tech company could report positive earnings but still depreciate because the overall industry is suffering severe losses, affecting sentiment in tech stocks. But what if you're trading a foreign exchange pair like USD GBP? Currencies can see increased volatility because of interest rate announcements, employment data releases, and economic growth statements. Currencies can experience increased volatility because of interest rate announcements, employment data releases, and economic growth statements. To stay on top of this, you can keep an eye on economic calendar and business news sites. Your chosen trading platform may also provide you with a live data feed where you can select your preferred sources, but you might need to pay extra for this service. Watch the economic calendars and business news sites. Did you know trading the news is a strategy used to take advantage of increased volatility in the markets caused by relevant events and economic data releases? This strategy is best suited to short-term positions as the outlook for the market can change rapidly, especially if the shared results are unexpectedly high or low. While trading the news doesn't require you to have advanced technical analysis skills, it may not be the best way forward if you're new trading. The news is unpredictable and resulting price fluctuations can be brief, increasing your risk. There's also no guarantee that the market will shift in any way or in the way suggested via announcements. However, it may not be the best way forward as a beginner trader to trade the news. As the news is unpredictable and the resulting price fluctuations can be brief. Which increases your risk. There's also no guarantee that the market will shift in the way suggested by the announcements. There's also no guarantee that the market will shift in the way suggested by an announcement. Before you choose which asset to trade, you may want to add which economic events might affect it to your research process, as well as when those announcements are scheduled to take place. So, before you choose which asset to trade, add which economic events will affect it to your research list, as well as when those announcements are going to take place. Remember, you can't prepare for everything. Things like natural disasters and war can't be predicted or prepared for and will likely affect your open positions. Remember that natural disasters. Remember that uncontrollable factors, let's call it that, uncontrollable, unpredictable factors such as natural disasters and war can occur and will likely affect your open positions. Derivatives. Cash price, derivative price. Trading derivative products amplifies the complexity inherent in the market. This is because they derive their price from an underlying asset using different methods. Derivatives derive their underlying derive their price from an underlying asset using different methods. With products like spread bets and CFDs, contract for differences, the price tries to mirror that of the underlying asset. So, with products such as spread bets and CFDs, the price tries to mirror that of the underlying market. Here, the reason for any difference between the asset price and the cost of trading it is due to the fees involved with opening a position. Any differences between the asset price and the cost of opening the position is due to the fees involved with opening the position. Trading it is due to the fees involved with opening position. However, once we enter the realm of options, it gets trickier. They use complex mathematical formulas to determine the price of a single contract. Many of the inputs for the formula, like the risk-free rate, volatility, and assumed dividend, are hard to determine. However, options as they use a complex mathematical formula, as they use more than one mathematical formulas to determine the price of a single contract. Many of the inputs for the formula such as risk-free rates, volatility and assumed dividends is hard to determine. So I'm assuming we won't know the values for these. Did you know the risk-free rate represents how much interest you could expect to receive from an investment if there's no risk involved? How much interest you could expect from it if there's no risk involved? This number is theoretical, as there's always some risk involved in any investment. To calculate a risk-free rate, you can subtract the inflation rate from the yield of a treasury bond that matches your investment's period. The latter is a type of debt-based investment product issued by the government. In essence, you loan them money in exchange for interest and the promise of your initial investment back when it matures. Subtract the inflation rate from the yield of a treasury bond that matches your investment's period. How much interest you could expect to receive if from an investment if there was no risk involved. A theoretical number which calculates how much interest you could expect to receive from an investment if there was no risk involved. Future also uses a derived price, but with a simpler calculation than options. Futures also used a derived price, but much simpler than options. But with a simpler calculation than options. Like other derivatives, these instruments closely follow the underlying market. There's also another layer that makes these products riskier and more sophisticated: leverage. As explained in the previous lesson, leverage requires a relatively small outlay, increasing the exposure to the market, which amplifies the potential profit or loss in the trade. Yep. Another nice diagram once again. If a market is volatile, your position's value can change rapidly. That speed means you might need to monitor it closely and act quickly, or have other risk management strategies in place. So if a market is volatile, your position can change quickly. This means you might need to monitor it closely and act quickly, or have other risk management strategies in place. Or have other risk management strategies in place. Online trading providers typically give you access to several different tools to help you manage your risk. Remember, you could have conditional orders such as stop loss in your provider system to act for you when you're away from your screen. If you choose to use a stop loss, you'll need to know where exactly you want to exit the trade to minimize your loss if the market moves against you. Remember, if you'd prefer to avoid slippage as well, you can use guaranteed stops, but they'll cost you if the stop is triggered. This may seem like a simple fix, but if your losing trade triggers your stop order and then the markets recover and move in your favor again, you won't benefit from this. Your position will already be closed and your loss, which might have been reversed, will stay. But still, use a stop loss. Use stop losses or guaranteed stops to minimize your losses if the market moves against you. How an instrument's complexity affects you. As a trader or investor, deciding how much complexity you are comfortable with is part of your journey. Remember, you can always build onto your knowledge, experience, and confidence over time, gradually adding more complex instruments to your portfolio. While trading leveraged derivatives can amplify your returns over time, some successful market participants only buy and sell shares and can still make a profit. If you're just setting off on your trading venture, you may prefer the latter. So doing the simple stuff basically. Did you know, have you ever thought that a car with built-in gadgets and add-ons was automatically better than any other? This phenomenon is called complexity bias. Have you ever thought that a car with built-in gadgets and add-ons was automatically better than any other? This phenomenon is called a complexity bias. It's when we place our preference on complexity over simplicity, even though it's not necessarily better. To battle the bias, try focusing on what you need the product to do, and if you know enough about it to achieve that aim. Often a more basic solution is easier to manage and can be effective for you. Ooh, that's interesting, I did not know that. Complexity bias. On the other hand, it's possible to become an expert in pretty much any product regardless of its complexity. The internet is full of videos, articles and any other information that can help you understand how a product works or where to find a broker that offers it. Homework. Want to get a sense of how different products work and how you can add them to your overall portfolio? Try implementing a risk scoring system based on how complex different products are. Each product can be rated with a general risk level ranging from low to high. Start the low end of the range and slowly work your way down the list. Tally how many products of each type you plan to use and compare them to your risk profile. If you're more risk averse, your product choices will likely fall into the lower risk categories. The goal is to match the complexity of your portfolio to your risk appetite, so if it doesn't, you might need to reassess your strategy. Remember, the core risk associated with each product isn't the only one you'll need to consider. A complex portfolio might give you more ways to access the markets, but will take more time to manage and might carry a high level of risk. True. So, yep. Product type. Passive investment products are managed portfolios. Core risk. The combined assets within an investment portfolio can underperform or lose value over time. Risk level based on complexity low. Company stocks and ETFs. These can decline in value over time and companies can be liquidated. Risk level based on complexity moderate. Company stocks and ETFs. These can decline in value over time and companies can be liquidated. Oh no, I already done that. Exchange traded derivatives like turbos, covered warrants, and constant leverage certificates that have built-in risk management mechanisms. If the market moves against you and you keep your positions open, you can lose your entire investment, entire initial investment, moderately high. Over-the-counter leverage derivatives like spread bets, options, and CFDs. If the market moves against you and you keep your positions open, you could lose more than your initial investment. High. Cash cryptos. These markets can become illiquid at any time should demand disappear because they are not regulated by any authority. Very high. Yep, okay. So lesson summary. When choosing a market to trade and which products to use, you need to consider how well you understand it. There are several factors that may affect the complexity of your trade, including pricing, the structure of the product, and use of leverage. It might be useful to monitor relevant news reports and economic events as they can affect your chosen market's volatility. If you're new to trading, it might be preferable to choose simpler products like investment portfolio and build your confidence first. If you're new to trading, it might be preferable to choose simpler products such as an investment portfolio to build your confidence first. A more complex portfolio means you could be taking on more risk and could require more of your time and attention. So a more complex portfolio means you could be taking on more risk and would require more of your time and attention. More of your time and attention. Cool. Yep, makes sense. Alright, the impact of time. Time is perhaps one of the biggest considerations when making trading or investment decisions. It can also influence your risk profile, which we discussed in a previous lesson. To work out which products could help you achieve your financial goals, think about when you'll implement your strategy and when you'll need to close it out. To find out which products could help you achieve your financial goals, think about when you'll implement your strategy and when you'll need to close it out. How long you plan to hold your positions can be referred to as something called your time horizon. It varies from traders to investors, and you might have multiple strategies running simultaneously too. Depending on your aims, understanding where your time horizons fall can help you better plan for your financial goals. Understanding how long you plan to hold your positions for can help you better plan for your financial goals. Investment time horizons. For the investment arm of your wealth building blueprint, you'll be looking to generate money that you only plan to use in the distant future. Here you may decide to hold on to each of your investments for several years. You can separate them into three distinct categories: long, medium and short term. These are based on your goals and can help you choose the right products to achieve them. So, investment time horizons. Trading time horizons. Right, okay, so there's different. You got investment and you got trading. Yep, okay, so investment time horizons. How long you plan to hold your positions for. So investment time horizons, you'll be looking to generate money that you only plan to use in the distant future. Here you may decide to hold on to each of your investments for several years. You may decide to hold on to your investments for several years. You can separate them to three distinct categories: there are three distinct categories: long term, medium term, and short term. These are based on your goals and can help you choose the right products to achieve them. What does that say? Potential returns. Time goes along, hopefully your investment return will go up. Long term, medium and short term, these are based on your goals, going to help you choose the right products to achieve them. Okay, I'm going to leave this episode here. In the next video, we're going to carry on with this, looking at the investment time horizons. So I'm assuming it's going to go through each one, so long term, medium term, and short term. And then we'll go through the trading time horizons. So yeah, so thank you all for watching, and I will see you all in the next video then. Bye for now.